Hey guys, so today I'll be covering Unit 3, which is revenue. Now, just to dive right into it. So interestingly enough, this CSG doesn't really cover in depth the normal revenue standards. It just very briefly mentions them here. So IS 11 construction contracts, that's basically recognizing revenue. As you complete the building in stages, that's when you recognize revenue. IS 18 revenue is just a really basic standard one. It's think about previously when you issued a contract, it's just the date of the service that you've actually provided. That's when you'd incur it. So it's nothing to do with cash. We're purely on an accruals basis. And we've also got some other specific ones, customer loyalty programs. But really, the only one that really comes up in the CSG, in the Fin module at all, is this new standard IFRS 15 revenue from contracts with customers. So it's recently just come in. It's effective from annual reporting periods on or after 1 January 2018. So obviously beginning on or after. So the first one that will apply for Australia at least will be from July onwards. So it'll be FY19 in which this is actually applicable. So I found this quite a confusing standard, at least in the way that it's laid out. But I am actually going to be going off the CSG simply because I've got so many different examples to really explain that concept to you. And once you understand the concept, you can refer back to the notes again. So what the new standard really does is it introduces this 5-step revenue model. And you basically have to follow each of these steps in the scenario to basically figure out what the correct amount of revenue is you have to recognize. So this is it. This summarizes the whole chapter. However, it does kind of go into detail into each of these steps and uses examples for more technical and complex instances of each of these. But on a very high level, if you can remember these 5 steps and understand how it works, and I'll show you this example in a second, then you've got this unit covered. Okay, so basically the 5 steps are: identify the contract with customer. Okay, so first of all, there has to be a contract. Otherwise, it might fall under a different revenue standard, or it might not even be revenue at all. Number 2, identify the separate performance obligations. So any contract basically has a contract to perform a certain service or obligation, whether it's, in this example below, we've got delivering a vehicle or providing an actual service, servicing the vehicle. So identifying those two different parts of what you're paying for. Step number 3 is determine the transaction price. So this is actually the dollar amount that you are paying on the contract. And step 4 is allocate the transaction price. So it's the dollar amount on the contract. How are you allocating this between the different services that you're paying for? And number 5 is recognize revenue when a performance obligation is satisfied. So it's basically saying, when do you recognize revenue? Okay, so let's go through this first example. It's very high level. So it's need a van signed a contract to purchase a delivery vehicle. Okay, so they're purchasing a delivery vehicle. The agreed purchase price stated in the contract is $20,000. And this amount includes 2 free services of the vehicle. The 2 free services will be performed 6 months and 9 months up to delivery of the vehicle. The selling price of the vehicle, excluding the 2 free services, is $23.50. Okay, so that's what you'd ordinarily pay for the vehicle by itself. The service fee for a 6-month service is $1,100, and the service fee for a 9-month service is $550. Okay, so to split this out into the 5 different steps. So number 1, is there a contract? That's the easiest step. Yes, there is a contract, and the contract is to provide the delivery van. Step number 2 is how you're actually splitting out the performance obligations. So you have to split out between actual providing of a physical good, which is the vehicle, and also the services. And you actually have to go into more detail than that because you need to know about when the timing of the service is provided. So you've got a 6-month service, and you've got a 9-month service. And obviously these have to be split out because we're going to be recognizing revenue at a different time for each. One at 6 months, one at 9 months. Okay, so that's number 2. So number 3 is determine the transaction price. So this is the dollar amount in the contract that you're actually paying. And the agreed purchase price in the contract is $20,000. Okay, so number 4 is allocate the transaction price. So you actually need to split that $20,000 across the items that you're purchasing. Okay, so the way that you do this is that you first of all, you look at the standalone selling price of each of those assets. How much would you ordinarily pay for each of those? And then you apportion how much you are currently paying in the contract by that same percentage. So the standalone purchase price of a vehicle is $2,350. A normal 6-month service, if you didn't have this contract, would cost $1,100, and a normal 9-month service would cost $550. So the total of that is $2,200, and we actually split that out. So that's 92.5% of the total, 5% and 2.5%. Right, and then we simply just times the total transaction price of $20,000 in the contract by those percentages, the standalone prices, and that gets the allocated transaction price, and that's what we'll be recording as revenue. Okay, so the final step is actually figuring out when we're going to recognize that revenue. Okay, so we've got the dollar amounts. So just splitting out into the 3 performance obligations. So we've got the delivery of vehicle. So that amount is going to be incurred when you actually provide the vehicle. The 6-month service is going to be earned or recognized when the 6-month service is provided, so 6 months later. And the 9-month service is going to be 9 months later. Okay, so this point here is just about how none of revenue recognition in accounting is to do with when you receive cash, because we are purely on an accruals basis. So if you look at the journals, this can be a little bit confusing if you just look at it up front, but if you think about it in a certain way. So first of all, how much revenue are you going to be recognizing on the first day, which is the 15th of March? You're going to be recognizing the sale of a delivery vehicle, which is $18,500. Now, the other side of the contract is how much cash you're actually receiving up front or on a receivable basis through an invoice, and that's $20,000. So revenue up front recognized is $18,500, cash received is $20,000, so the difference is actually an account called revenue received in advance. It's actually a liability account because you have a liability to provide that service or good later on. So that's how you kind of figure out the journal. First of all, you think about the revenue, then you look at the cash received or the invoice via the trade receivable, and then the difference is going to be actually revenue received in advance, so it's cash before you've actually provided the service. Okay, so the next step is, this step is arbitrary. It's basically whether or not they've received cash and paid off that trade receivable. Not too important. But here, this journal, we're actually looking at the next step, so the 6-month service. So have a look at the dates. It's the 15th of September. It's actually when they're providing that service. So think about the revenue side. So they're going to be recognizing $1,000 of revenue. And the other side is going to be offsetting the revenue received in advance, because they've already received the cash for it up here. But only now are we recognizing it. So we've still got $500 left over for that last service, and that's the final journal. So on the 15th of December, that's when we're actually incurring the last 9-month service. We've got the revenue received in advance of $500, and then we've got the revenue from contracts with customers of $500. So that's basically how it works. It's kind of simple when you think about it, but when we really drill down to each of those individual steps, they can make it a little bit difficult. Okay, so the first step, identify the contract with customers. That's this step up here. Should be a pretty easy step because normally they'll just tell you in a question if there is a contract. There is a actual flow chart for you to follow. Very rarely in a question do you actually have to go through and tick each one. Generally it's just, is there a contract or is there not? I'll let you read through this in your own time and go through the complex example as to whether or not there is a contract, because sometimes I guess it could be a little bit either way, but generally in an exam question it's either is or isn't, so I'll leave that one out. You can read that in your own time from the CSG. So the second step we're going to look at, still in the first step, but there's another issue you need to consider in terms of contracts, and it's probably one that I will go through. It's considering the potential combination of contracts. Now, under the old standards there was a way to kind of manipulate your revenue, because if you had separate contracts, for example, product A, product B, product C, you can kind of, you're going to provide all of the services, but you can manipulate the contract so that the higher selling price comes in one financial year and the lower price comes in a later financial year, or vice versa, really depending on the kind of financial results that you want manipulated. So in this example here, this is the agreed selling price. This is what between two parties, and it does look like there's been some manipulation here, because if you look at the normal selling price, product A generally sells for $5,000, product B generally sells for $15,000, and C for $80,000. So they've definitely changed the agreed selling price. So you can kind of see how profit can be manipulated through this method. So if they were to recognize it as 3 separate contracts, you can see that $85,000 is going to fall into FY18. Maybe the CEO or CFO wanted to bring forward revenue so they could get their bonus into FY18, for example. But under this new standard, we have to actually consider whether or not we need to combine those into its true selling price, its normal selling price over here, so 5,000, 15,000, 8,000, which of course would put the majority of the profit into the next financial year. So you can see there's a fair amount of difference. So there is a flow chart, and it is kind of important that you need to follow as to whether or not you need to combine them. So there's a few key steps. So first of all, are the contracts entered into at the same time? So that's one first key point. Number two, is it the same customer? Number three, are they part of the same single commercial objective? For example, you might be refurbishing a house. Are they all in aggregate for that purpose of refurbishing the house? And there's some other minor steps, but these are the three main key ones. So does the amount of consideration to be paid into one contract depend on the price or performance of another contract? So that's another important one. Yes, combine the contracts. Are the good or service promised in each contracts a single performance obligation? So similar to the commercial objective, but on a detailed level, are they the same performance obligation? Yes. Generally, you only go through these for 3 steps, and then yes, you would know whether or not to combine the contracts. So let's have a practical example down here. So it's actually a home building contract. So the normal selling price, if it was a arm's length fair market transaction, the normal transaction price for each of these, so renovation 50,000, main bathroom 35,000, and pool was 80,000. However, for whatever reason, maybe they know each other or it's a related party transaction, they've managed to skew the contract price to 150 for the kitchen, 10,000 for the bathroom, and 5,000 for the pool. So very out of the ordinary. So we have to figure out whether or not we're going to combine the contracts under this new standard. So first of all, go through the usual steps. Is there a contract? Yes. They signed 3 contracts in November 2016. So that's a very similar date. So that's the first point in the flow chart. Are they entered into it at the same time? Are they entered into the same customer? It's all Miss A.D. Parker and a spouse or related party of this person. So yes, they're all related. They're married, therefore related parties. And the final point, are they negotiators package with a single commercial objective? So the commercial objective is to actually renovate the house. So even though each of these renovations is slightly different, bathroom, kitchen, etc., they're all part of the same objective to improve the overall house at the single premises. So yes, we can establish that yes, we have to combine the contracts in this instance, and then instead of recognizing the contract at this price, we recognize the revenue at this allocation. So the transaction price. So go through the normal steps. So number 2 is identify the separate performance obligations. So it's kitchen, main bathroom, and pool. Fortunately, they're the same as up here. Otherwise, we'd have to combine the 2 if they were part of the same obligation. Determine the transaction price. So the transaction price, the dollar amount on the contract, is $165,000, as you can see there. And number 4, allocate the transaction price. So this is actually, because we're combining the contract, we can allocate that between their standalone price. So it's actually going to be these 3 amounts here. So recognize revenue when a performance obligation is satisfied. So this is actually, when are we going to actually recognize revenue? So as usual, you recognize revenue when the performance obligations are satisfied. So when you actually conduct the service. So you've got to look at the dates when each of these are completed. So it's completed in December 16. So again, it's nothing to do with the date of the contract or when it was paid. It's when you've actually provided the service. So this one will be recognized in December, this one in July, and this one in September. Okay, so first of all, let's look at the journal entries. So, they haven't provided us with journal entries, but just on a quick high level, if they're paying up front, 31st of October, you want to recognize that as debit cash or debit trade receivable, and then credit revenue received in advance. And then as you recognize each of these revenue amounts, so $50,000, you credit revenue to debit revenue received in advance, etc. $35,000 on the 16th, in July 2017, and $80,000 in September 2017, etc. Okay, so moving on to step 2. So it's identify the separate performance obligations. So even though you can have 3 separate things, if they're not part of the same service obligation, for example, if these were both to do with the bathroom, we have to combine these two because it's part of the same service obligation, is to renovate the bathroom. This one would be different because it's renovate the pool. And then that would influence how you're actually allocating the transaction price as well. So have a look at this example down here. It's actually a gym membership. So in this instance, they've got a gym and they've got a joining fee. So that's just a $600 on the spot up front to cover admin costs. You've got a monthly membership fee, $100 per month payable in advance, and you've also got a maximum membership period. Okay, so that's basically after the end of 12 months, you have to pay the joining fee again all over again. But this is next year, so this doesn't cover the current financial period. So we're not going to recognize that. Okay, so if we go through the usual steps, is there a contract? Yes. See how easy it is. It's just, there's a contract to provide a gym membership with the customer. Really simple. Number 2 is identify the separate performance obligations. So this one's a little bit tricky because this is the catch. They only have one performance obligation. So you might think up front, yes, there's an obligation to pay a fee and there's an obligation to pay a membership fee. However, you've got to think about what is the contract providing, and the contract is only providing the gym membership. There's no split between the fee, it's what the service you're providing is. So it's the provision of the gym. Okay, so that is it. So this is the trick to the question. So now go through the rest of the steps, but when we actually allocate the purchase price, it's going to be just based on that single performance obligation. Okay, so the total transaction price is $1,800, and the way you work that out is it's $600 up front plus 12 months of $100 each, so it's $1,200 plus 600 equals $1,800. So that's the total amount of the contract. And if you have a contract in real life, you probably have a minimum contract spend. Like if you get a mobile, it'll say minimum spend over 24 months or 12 months is this amount of money. That's how much is the transaction price. Okay, and the final step is actually recognizing when the performance obligation is satisfied. Okay, so let's think about the cash up front. So there's 2 types of payments. There's the initial upfront payment in cash, and then there's the payment on an ongoing basis. Again, we're only talking about cash. This has nothing to do with when revenue is actually recognized, because they're 2 different concepts. Okay, so first of all, let's think about the cash. So up front, they're paying $600 for the admin fee. So we're going to pay $600 in debit bank, because we're receiving the cash. And the other side is revenue received in advance, because we are not recognizing the revenue up front, because the performance obligation isn't provided until every month it is provided. It's not provided up front. So the revenue is received in advance. Okay, so now let's go to the next month. So for the first month's installment, so we're paying $100 in bank, and we're also receiving revenue received in advance, simply because they're paying for that membership on the first day of the month. Now, when do you actually recognize the revenue? It's after you've provided the gym membership for the full month. You're providing a monthly gym membership, therefore you wouldn't recognize it until the full month has been provided. So you'd recognize it at the end of the month, and you're going to go credit revenue, $150, because you've now provided the service, the monthly membership subscription. And the other side is, it's an offset to revenue advance, because you've already received the cash for it. So it's just offsetting this account here, revenue received in advance, and this account here, revenue received in advance. And you just do that every month for 12 months at the end of the month, once you've provided the service. Okay, so I'm just going to skip through this because it's not as important. We're going to go straight to the next one, so determine the transaction price. So it's the dollar amount of the contract. So again, this one's not too difficult either. It's similar to step 1. It's generally just the dollar amount on the contract. You can skip through it. There are a few minor details. For example, the settlement, if there's a discount on trade, you do need to offset it. For example, in this example, sales price is $250,000, but they offer a discount, so you just need to factor that discount in. Really simple. It's not even unique to this particular standard. It's the same for other revenue standards as well. And same for refund liability. So in this example, they've got they sell a good for $50,000, but they're expecting that they might have a liability of $7,500. So we're not going to recognize that revenue. So it's going to go debit cash, credit sales revenue, net of the refund liability, and then credit refund liability. Once that amount's actually paid out, you go debit the liability and credit cash. Or alternatively, if that refund's never paid out, you actually have to recognize it as revenue again. So you'd actually debit out the refund liability and credit revenue back up to $50,000. Okay, so just moving forward, so there can also be variable consideration as well. So there's two types of scenarios. There's like a probability-based one, where an increased percentage will increase the payout, or it could be a binary or most likely amount, where it's either you're going to get the amount or you're not going to get it. So basically, the most appropriate approach for recognizing that revenue on an expected value is actually applying a probability for each kind of component. So for example, if you've got a multi-tiered contract and there's a 35% chance that they're going to get paid out $250K, there's a 45% chance they're going to get paid out $247.5K, and there's a 20% chance they're going to get paid out $245,000. You kind of do a sum product or apportion each of these, so it's 250 times 35% equals 87,500, and do the same going down, and that's the revenue that you actually recognize. So that's the revenue based on probability. The other side of it is the likely amount. So it's either a binary yes or no. So they're either going to receive this award fee or they're not. So you have to deem whether it's likely and recognize that full amount, or if it's not likely and not recognize that amount as revenue. So in this case, the contract price is $500,000 plus a $50,000 award fee if it's completed by a specified date. You have to deem whether it's expected to be paid or not. And in this situation, they expected it to be paid, so therefore they've included that as revenue with contracts, and revenue is $550K. Okay, so just moving forward, just skipping through some of this stuff that's not as important. There's a very minor point about when you've got a net present value. So that's basically when you've got a future liability in a future year to actually pay them out. For example, in this situation, they're selling furniture to a customer on credit for $100,000. But the net present value is $90,000 at the beginning of the year, and it slowly increases over time because of time value of money. So basically what you would do is you'd recognize the net present value up front at $90,000, the other side going to trade receivable, and the rest of that that difference between the $100,000 and the $90,000, or the net present value, actually goes into interest received because it's the time value of money. That's the interest rate that you've got on that money over time. So you actually recognize that as interest revenue, not sales revenue. Same for this down here, $3,500. Okay, so just moving forward, so non-cash consideration needs to be at market value, at fair value. So in this case here, they've got an agreed selling price at $80,000, but the standalone price is $75,000, so you need to record it at $75,000. So quite similar to what we were looking at before. Nothing really new there, just a different way of saying it. Okay, so we're up to step 4 again. So allocating the transaction price. So it's basically the amount on the contract. We've got this example here. Again, it's nothing really new. We've already really covered this. It's just drilling down to it in a little more detail. So in this case, we've got a transaction price of $100,000. So that's how much they're paying for it. And the standalone price for these services that they're providing is $66,000 and $33,333. So we just have to recognize the revenue in those proportions. We've already been over this really simple stuff. And yeah, this is just about timing when we're going to actually recognize the revenue. So when actually providing the service. So in this example here, they're providing 3 different buses at 3 different periods. So March 2012, May 2013, and 31st August 2013. And it's just saying here that you'd recognize each of those different revenue components at those dates. But again, we've already been over that in the first question. Really, it's just drilling down into more detail. And that's pretty much it. So it's really not that difficult once you think about it, but just the way everything is laid out is quite complicated. But yeah, that's the end of chapter 3. So if you scroll to the next video now, which should be on income taxes. Thank you.